India is one of the world's biggest sugar producers and exporters. Yet after nearly a decade, it may have to turn to imports to bolster domestic supplies. The government is planning to allow around 1 million tons of raw sugar at nil duty as domestic sugar prices rise ahead of the festive season. In Maharashtra, benchmark ex-milk prices have reached around 5,400 rupees to 5,560 rupees per quintal. So why are sugar supplies under pressure and will imports bring prices down? The pressure has been building through the 2025 to 2026 sugar season, which began on 1st October last year. Domestic sugar consumption has exceeded production, leaving mills with increasingly limited stocks. And that's particularly important because India is entering the festive period when sugar demand typically rises. But there's another factor behind the tighter supply: exports. In November 2025, the government allowed mills to export 1.5 million tons of sugar. That quota was later increased to 2 million tons. Around 0.8 million tons had been shipped before exports were prohibited. Industry officials argue that those exports added to the pressure at a time when production was already struggling to keep pace with consumption. And that has created an unusual reversal. India began the season allowing sugar exports. Now, months later, it is considering imports. The government is also asking mills to begin crushing sugarcane earlier to bring fresh sugar into the market. But that alone may not be enough to rebuild the supply cushion. India's net sugar production for 2025-2026 is estimated at around 27.9 million tons after accounting for 2.4 million tons diverted towards ethanol. The country began the season with nearly 4.7 million tons of opening stocks. That takes total availability to roughly 32.6 million tons. With domestic consumption estimated at around 28 million tons, that may initially look comfortable. But the buffer shrinks once exports are factored in. Closing stocks could fall to around 3.5 to 3.9 million tons, compared with about 4.7 million tons at the beginning of the season. Industry officials consider roughly 6 million tons or around 3 months of consumption a comfortable stock level. So India could enter the festive period with a much smaller sugar cushion than usual. And that's where the proposed imports come in. But will importing 1 million tons bring sugar prices down? Experts say it could provide some relief, but probably not a dramatic correction. Prices could fall by around 500 rupees per quintal at best. Even after that, they would remain above the estimated production cost of around 4,200 to 4,300 per quintal. That could also help mills generate enough cash to clear sugarcane dues faster. There is also an international price angle. Following news of India's planned imports, raw sugar prices in New York climbed to a 14-month high of nearly 17.47 cents per pound. At those prices, the landed cost of imported raw sugar at nil duty is estimated at around 3,840 rupees per quintal. Experts say that could still leave mills with a positive margin on imports. So for consumers, the proposed imports may be less about making sugar dramatically cheaper and more about preventing prices from rising further as festive demand picks up. India isn't suddenly running out of sugar. The problem is the size of the buffer. Lower available stocks, exports, ethanol diversion and rising seasonal demand have tightened the market. 1 million tons of duty-free imports could help rebuild that cushion. And that explains the unusual reversal. One of the world's biggest sugar producers could go from exporting sugar to importing it in the same season. Follow Business Standard for more such stories.